Hi, Dave Stanfield again with Evergreen Wealth Management. In this video today, I wanted to cover the last category of annuities, and that is equity indexed annuities. And this is something that I've been utilizing a little bit more in my practice in recent years, and there's a few reasons for that. But the way essentially that many of them work is I like them because you can take this lump sum of money, let's say, $500,000, you put it into this product, and it sets a floor, a guaranteed floor, so that you will not lose money. You will always get returned. The insurance company guarantees that you're going to at least get your money back over a period of time if you play by the rules of the contract. The benefit, however, is that you can still participate in the market going up to some, and there's different products that offer different participation rates, but it can be tied to some market-based investment like the S&P 500 or a balanced kind of an investment product. So it's nice that, again, there's a floor, but you can participate in the market going up. So I use them in two different situations typically. One is where someone is comparing guaranteed investments. So they're looking at the differences between money market accounts and CDs, a bond portfolio, bond mutual funds, and then we might throw this in as an option as well into the mix, equity indexed annuity, and kind of compare the pros and cons. And right now, because we're in an environment where interest rates are very low and eventually rates will likely increase, and there's this inverse relationship between interest rates. When interest rates go up, the price of bond investments can go down. So people are looking down the road, no crystal ball, of course, but 5-10 years and what returns they might get in bond investments. And should they do that, or should they go into something like this, where you're guaranteed not to lose money, but you can participate if the market goes up? So I think it can be a good hedge as an alternative, a unique investment option, and looking at it, comparing it to other guaranteed investments or bond type investments. That's one category as a bond alternative. The second way that I use them is for income planning, as an income planning tool. So in that same example, we put money, we dedicate it into this investment, but where they usually work better or best is if you don't start taking the income right away, but you can delay taking it for 3 years. So they may work really well for someone that's in their mid 50s or early 50s, or it could be later, 60s, 70s, but someone that, let's say that they want to retire at age 65 and they're 55 years old right now. So they're going to take some lump sum of money, put it into this contract, a deferred equity indexed annuity, and then they're not going to take income from it until they retire. But they want a product that is structured so that they can get a guaranteed income from it in the future. So in the meantime, they can participate in the market on some level if interest rates or if the market does well. But also there's a built-in, sometimes an income rider that will tell them very specifically a certain percentage or dollar amount of income that they'll get 5-10 years down the road, and it's outlined in the illustration. So those two scenarios, either as a bond alternative or as an income planning tool, but I like them sometimes a little bit better, an equity index annuity, than a immediate income annuity, for example, because with an immediate income annuity, you are trading your lump sum of principal and no longer have control over it. And so an equity index annuity can give you that limited option after the direct surrender charge period, where you can still maintain your principal and get your principal back, and it's guaranteed in the meantime. So, but I'd love to talk with you about it and help you weigh your options on annuities, and if they make sense, call me anytime. Thank you very much.